Thank you very much. My name is Aloysius Fekete. I'm Chief Product Officer at AltFi Data, and it's my distinct pleasure to host this panel, which I think is you'll find very interesting. We have a broad range of originators representing different geographies and different business models to discuss risk and return across Europe. So to start, I think I'd like each of you to introduce yourselves and tell us a little bit about your platform and your business model.
Niels Turfboer, MD at Spotcap. We're a global firm currently present in 5 countries. We're a balance sheet lender, which means we have a lot of, it was touched upon, we eat our own cooking. I think we're present in APAC and in Europe, and I hope we'll have an interesting discussion about the differences between the markets where we operate in.
I'm Patrick de Nonneville. I'm the CEO of Lendix. We're a small business lender in continental Europe, currently operating in 3 countries. We are funded both by retail investors coming on the platform and a fund that we are the asset manager of at the same time.
Hi, I'm George Georgakopoulos. I am the Chief Executive of For Finance. My background is banking. I have done 20 years in banking with the Barclays Group, mainly in London, and the Eurobank in Southeast Europe. Last job before this one, I was Chief Executive of a bank in Romania, one of the major banks. So my background is banking. For Finance is a major consumer finance company, balance sheet lender. We're present in 16 markets, 13 European markets, 3 Latin American markets. We issued last year 1.2 billion. So a very large-scale operator.
Hi, my name is James Levy of Clearwater Private Investment. In fact, I'm not an originator, and that's why I have this little separation here. I'm actually a wealth manager coming from background in Merrill Lynch private banking, and I've been something of a writer and a champion for marketplace lending as a source of stable, low volatility returns for investors, a champion from the investor side. I'm based in Madrid and Luxembourg and advise family offices in Madrid, Luxembourg, and London. And a pleasure to be here. Thank you.
Thank you. So at AltFi Data, we spend our days wandering the fields of Elysium, dreaming about transparency, about disclosure. And it's beautiful. Everyone can see it. The data is consistent. The analytics is comparable. Niels, bring me down to earth. You wrote a piece yesterday and said it's a matter of perspective.
Yes, I think it depends a lot on the markets where you're in, to start with. If I look at our company, we operate in the UK, where clearly there are some of the larger firms that work towards disclosure. We also operate in the Netherlands, where we can see there is the wish for disclosure, but the actual reality is not there yet. Only this week there was a top scholar in the Netherlands writing a quite critical piece about the sector, saying it's still far away from being very clear what the risk is and what the risk return is. I also think in terms of our own position, let's be very frank, we're a balance sheet lender. We actually escape any scrutiny of numbers. And you can ask the question, is that the way we want to move the sector forwards? We don't have investors, and therefore we actually don't have to disclose anything. In the UK, we show an average APR, but not a default number. And in countries like Holland, we don't even have to show an APR. So we could be basically the shiny BMW with something really nasty under the hood.
Interesting. So going from a balance sheet lender to a marketplace lender, Lendix took a big step the other day in disclosure. What's your perspective, Patrick?
It's, I mean, we come from a very different business model, so we have different needs. And one of the things that we need for a marketplace lender to work is trust. And how do you do trust? You do trust by having skin in the game. And skin in the game can be done in different things. We can talk about it later. And transparency. And for us, transparency goes from things that we do ourselves in terms of, showing our portfolio to anybody who comes on the platform, to publishing statistics, which are actually decided by the regulator in the countries we operate to. So normally you have a framework, but even there, you can have platforms who don't really stick to that. And as you said, so we're now very, very proud to be the first non-UK, non-US platform to have given all our data to AltFi Data in order to have not only that data available, but also giving people the ability to analyze it in a consistent framework with everything else. And we think this is one of the three pillars that we base Lendix on, is this transparency and this commitment to providing the data to anybody who wants it.
So, and George, you're also more like a balance sheet lender.
We're a big balance sheet lender. We have balance sheet 1 billion euro, and we issue annually 1.2, 1.3 billion euro. So it is this sort of large-scale operation. Last year we had almost 8 million applications, and we approved 3.5 million, and we dispersed 3.5 million loans. So it is this type of operation. So if I give the perspective of, let's say, a mature company, mature operation, still growing, and growing quite well, had revenue increase last year 24% from 15 to 16, so we still have growth, but is a mature company. I think I would like to touch on two concepts that we have found extremely useful, and indeed is transparency and disclosure. Transparency has worked very well for Finance, at least with two key audiences. Audience number one is customers, and audience number two is regulators. So transparency has helped us actually. Part of the product set we have, by the way, 45% of the balance sheet is short-term lending, and quite sensitive type product. Transparency has helped us to have extremely low customer complaints, very, very high customer satisfaction, and no regulatory issues in any of the jurisdictions that we operate. So I would say that transparency in the core product proposition is absolutely key for long-term success. If one takes, for the Finance example, it has issued 4 billion euro year to date. To date, 4 billion euro as an example, as a key characteristic of what drives success. So transparency to customers and regulators. And then is the heart of the issue, I think, is disclosure. Yesterday we started a bond offering. Actually, we made an announcement. We are seeking to raise up to 350 million USD. And to get to that level, the disclosure is really substantial. We issued 500 pages disclosure booklet. And this is the way it has to be. So I don't know if any platform, has to issue 500 pages, but the point is that to get into very meaningful investment, a very, very high level of disclosure is required. We're used to it because we've been doing significant issues of bond issues for a number of years now. So we're quite used to it. But I would say if one wants to attract serious investment, disclosure and standardization is absolutely key. In our case, is way of life.
James.
From the investor perspective, I'd say that's a really interesting point. Is one of the things I wanted to touch is securitization as a way forward. Because precisely the problems we face, trust, for example. It reminds me of President Reagan saying, trust but verify. Investors don't want to spend their time going through the verification process. They look for a short run, a shortcut. A shortcut can be various types. For example, the initiative of AltFi Data, that provides a shortcut for me to see what's happening, what's there. Another shortcut that's more difficult to achieve, as George was saying, is securitization. Securitization in any serious jurisdiction is an extremely difficult process to take place. I'm working now with, for example, a real estate bridge lender that's working on the first securitization of real estate bridge loans in Europe. Or secondly, for example, trade finance. Synthesis recently achieved the first securitization of trade finance loans. It wasn't economical to do. It's very expensive, but it's a process forward, so investors will be able to place larger amounts into their funding. But there's one other step, and I'd like to mention, without taking too much time, that I think is overlooked a great deal, is simply the banks. Investors anywhere in the world, in Spain, for example, they'll place their money with Barclays Bank, they'll place their money with a Spanish bank or with a French bank without thinking twice. The bank is a stamp of approval. A bank that offers a marketplace lending product is going to find many, many fewer questions on the point from the investor. Another way forward is simply collaboration with the banks. I know that from the investor perspective, well, gee, my guy at Barclays recommends this bridge lending fund. He recommends this small business lending fund. That would have the seal of approval immediately. I understand we're not exactly there yet, but I would encourage everybody here, don't see the banks as the enemy. It's a short way of achieving the volumes that need to be achieved in order for this to become truly a substitute for the miserable current account interest rates for investors.
I would like to respond to, I think, the last two speakers. I agree fully with George and also with James, but these are good examples of the industry. I like to count ourselves also to the very good examples. If you want to deal with a bank or you want to be sustainable and growing, you need to have your stuff in order and be transparent. Yeah. However, I think in a broader context, how do we guarantee that the entire space will live up to that? Not everybody's looking for a bank. Not everybody's in the game for a long time. And I can honestly tell you from where we are sitting in a lot of markets, I do see players where I have my doubts what their end game is. So in that sense, I think the UK, especially with AltFi Data, is taking the first strides to self-regulation, to basically imposing industry standards, where I come from in Europe and where I look around, it's not there yet. And what we see is the regulators are now moving in. Which is not per se a bad thing. I am in favor of a combination of self-regulation and some backstops from the regulator, but I do think the best examples are maybe not a good showcase for the entire industry.
Actually, I would argue that exactly they are. And let me tell you the For Finance experience. For Finance is a 9-year-old company. Started as a small company doing loans in Latvia 9 years ago, effectively coming to close the gap that the banks were not closing. So there was obvious need. The banks decided not to lend. They had their own issues. So somebody had to come in. And many small companies came in. Now, finance became a very substantial company from 13, 14, when it started. First of all, raised sufficient equity. But at some point, 13, 14, started raising sufficient debt capital. And to be to that level to raise debt capital, had to raise the standards of disclosure. Had to become a proper company suitable for major investors to come in. It took this huge step forward, becoming a credible investment vehicle for institutional investors. And of course, this totally changed the capital structure, the muscle, and got the company where it is today. Many people started. I don't think many are the size today of For Finance. Actually, I don't think anybody is the size of For Finance. The key thing that For Finance did significantly different in the capital structure and organization was it went and raised capital in the debt capital markets in 13, 14, 15. The others did not. But to be able to do that, had to raise the quality of the company internally. Goes with disclosure, with standards, and so on and so forth. So I would think if somebody wants to say, hey, no, I'm starting now, what should I do better? I would say For Finance might be a good example of what to do, and it is setting up a proper corporate structure, capital structure, organization.
I fully agree with this from the standpoint, if you're in the market to build a sustainable, great company. And I do think it's naive to think everybody wants that. So in that sense, I think For Finance is a perfect example how to do it right. And I fully agree with you. You will never get the bank money, the institutional money, because that comes with a lot of scrutiny. However, I'm more concerned about players with a different agenda, and they will have their effect in the market about trust of the entire sector.
The exact players with such agenda have existed in the markets that we operate in. The best thing is to go and insist to the regulators that they come to regulate.
The regulator has a huge role to play in this. And I think what we see happening in the UK, where effectively the industry developed very quickly and then the regulator came in, seems to work okay. In the US, maybe the regulator is a bit behind the curve, so it's going to be a big question of what happens there. And typically in the markets we operate in, the regulator is slightly ahead because what we do was forbidden until the regulator said we could do it. So in a sense, it's a chance, as long as the regulator does play their role, which is not always the case because they don't always have the resources to do it.
And I hear two things. One is it's an issue about growth and also expanding into other regions. And I think all of you are multinational and working in different geographies. Lendix recently moved into Spain. Can you talk a little bit more about that as you move into new geographies? How does that impact inform your disclosure and the issues around skin in the game?
For us, the disclosure issue is actually very simple because we're taking whatever the maximum disclosure the regulator is asking us in any other jurisdiction, and we're going way beyond that. And we're going beyond that consistently across all those jurisdictions, which maybe is a bit brave and stupid, you could say, going into someplace new. But we really believe this is something we need to do. And on the skin in the game side, same thing. I mean, it's not because we're going into a new market that we're doing it differently. So the way we addressed it at Lendix, so we're not a balance sheet lender, but we think there's huge value in having your own skin in the game. So the shareholders, the management of Lendix, the fund that invests on every single loan that goes on the platform, we've invested significantly in that on a personal basis as well. And it might sound, anecdotal, but it's not at all. I mean, I can tell you it informs not only the decisions that we take on a day-to-day basis, but also our discussions with, when we attract significantly sophisticated institutional investors for such a young company, it makes a lot of difference.
James, coming from the investor side, this issue of skin in the game, and we recently, there was an earlier investor panel talked about the need for transparency and comparability. Can you speak a little more to that from your perspective? Well,
a question I often receive from investors when they're considering an alternative lending investment is, do the managers, do the fund manager, do they have their own net wealth involved? Is there net wealth there? That's one. And that's an issue that has some importance, but it doesn't satisfy me entirely. A group of people, okay, they have their net wealth involved. We've seen how many hedge funds blow up with how many hedge fund managers had their big part of their net wealth there. In fact, you could steal more than your net wealth quite easily. I'm more satisfied, for example, with I personally prefer some type of secured lending rather than entirely unsecured. And whether, for example, and then if we talk about that in geographical areas, mentioning Spain, for example, a market I know very well, secured lending in Spain means nothing. It means nothing. You can go to court, it'll take years. If you talk about secured lending in the UK, Germany, it's a very different thing. That's a geographical variation that very much needs to be taken into account. How quickly one can get recourse if the loan does go bad, and how that recourse is taking place. In Spain, a country I know well, there's a different attitude, both in the courts and towards people in general, towards repayment of debt, than the Anglo-Saxon approach. So that's an area to consider.
If I can add on, I said we're in 5 different countries. It's definitely a challenge, but we take sort of the same approach as you, Patrick. We have a Dutch saying, we like to be more Catholic than the Pope. So we want to be on the safe side of regulation.
They really say that in Holland?
Yes.
They say that in Spanish too.
Yeah.
Oh, in Spain, okay.
Sorry, very local phrase. No, but the reason behind it is I feel as the industry is moving to maturity, so will the regulators, so will the environment. So we've always chosen whatever region we go in. We're operational in Spain, which has a very different legislation and regulation than, for instance, Netherlands and UK. We chose to be more similar in all countries rather than different and go for the highest form of regulation.
We have time for a couple questions, and there's one here specifically to the investor side, which is, how do you see originators in the different buckets? So comparing balance sheet lenders versus private lenders versus marketplace lenders.
I have a personal bias, but it doesn't so much, as I mentioned, towards secured lending. But don't misinterpret me. There is a place for unsecured lending. The question, there's a place for all different types of lending. I find this is one of the few areas, one of the only investment rules that actually make any reality, any truth in reality. As Rupert pointed out, most of them are garbage. Volatility or value at risk and so on, it's absolute lies. But diversification is true. And the one advice I would say to investors, diversify. You may be in this type of lending, you may be with a balance sheet lender, you may be with non-secured, you may be in trade finance, real estate, diversification. It's a very broad church, the alternative credit universe, a much broader area than we're accustomed to now in the regular security markets of bonds, which have also become meaningless because of quantitative easing. There's a universe of opportunity out there. But some will fail. The mistakes, things are going to blow up along the way. That's inevitable. So normally I would say to investors, no more than a certain percentage of your assets in each of these different types. Not to say all of alternative lending should be only 5% or 10%. I hear these figures. My investors I advise, many times alternative lending is 50% or more of their portfolio. And real estate is the other half. But of that 50%, it's broken down among as many different types of lending that we can find. and with many different types of guarantees, whether it's credit expertise or security of secured lending behind. So that's the advice I would give.
Thank you. I'm conscious of time and also that this is a penultimate session. I think everyone's eager to get on with the drinks and networking afterwards. So if there are no further questions, then I think we'll move on to the final session of the day. Thank you very much.
Thank you.
A pleasure. Hey.